nearly impossible to change the economic policies of Bitcoin. And if you compare that to Ethereum changed the economic policies with every hard fork. And so it's changed it half a dozen times. You take your money and you invest it in a bank account and you get 3% after tax, and everything goes up 10 to 15% a year in price, and you just get poor. And everybody shares this common economic protocol for settling their differences in a fair and an equitable, transparent, unstoppable, immutable fashion.
Michael Saylor begins by emphasizing the need for a monetary network to be ethically sound and robust in its engineering and economics. Bitcoin, he explains, exemplifies these qualities through its fixed supply of 21 million coins. This supply is virtually unchangeable, a characteristic that ensures its scarcity and reliability. In contrast, other cryptocurrencies, like Ethereum, frequently alter their economic policies with every hard fork. This inherent mutability undermines long-term trust and stability. Saylor contrasts Bitcoin with Ethereum, noting that Ethereum's economic policies have changed multiple times. This raises questions about the long-term predictability and stability of Ethereum's supply. For investors, the certainty that Bitcoin's supply will remain fixed is a critical factor. It ensures that when you buy Bitcoin, you are purchasing a specific portion of the network's economic energy that will remain consistent over time.
If you're trying to launch a monetary network, you need it to be ethically sound. It needs to be sound ethics, sound engineering, sound economics. The economic policy of Bitcoin is 21 million coins unchanged. Very difficult to change, extremely conservative. In fact, no one would ever think you could change the supply, which is transparent. And even the second order economics, the bandwidth of the network is the subject of bitter fights. The block size wars was a fight over whether or not the second order scarcity should change and whether the bandwidth should change. And as the network gets bigger, it becomes much more conservative economically. So now it's nearly impossible to change the economic policies of Bitcoin. And if you compare that to Ethereum changed the economic policies with every hard fork. And so it's changed it half a dozen times. And so economically, the real question is, how much of that asset will there be in 100 years or 1,000 years? And can anybody change it? And what you really want is for nobody to be able to change it. And you want to know that you're buying 1/21 millionth of all the economic energy in the network 1,000 years from now. So all of the hardware, all of the semiconductor technology, all of the electricity that's being used to secure the network disappears. Now the network is secured simply by the staking of a token with economic value. But you're going to lose Moore's law, because if you have to stake $50 billion of tokens, you can't make the $50 billion of tokens worth 500 million and keep the same amount of security over time. But you see, with Moore's law and with a silicon ratchet, you can actually create $50 billion of security with $500 million of hardware over time. Let me illustrate it a different way. You have 100 billionaires in a room, and then one middle-class dude with a $300 gun walks in. Who's the most powerful person in the room? Right? The guy with the gun. The gun is a very special purpose machine for projecting and channeling energy. If you actually want to get productivity, if you want to spend $300 in order to hijack $1 billion, right? You do it with a gun. But on the other hand, if you want to protect $1 billion without spending 10 or 20 billion, you protect $1 billion with the hardware. So the engineering of Bitcoin plugs you into semiconductor technology, to Moore's law, to electricity. And what it also does is it creates this very interesting dynamic where if you have billions of dollars of Bitcoin in Manhattan, your Bitcoin is being defended by Bitcoin mining off of hydroelectric power in Bhutan. You might be getting defended, the network is defended by a Bitcoin mine running on stranded natural gas in Kazakhstan. And so if your money is only defended at a bank in New York and the mayor of New York wants to seize your money, he just takes it. What you want is a very distributed network, and you want incentives for every nation state and every type of actor to build massively powerful centers. If you see these Bitcoin mining centers, they're 100 megawatt, 200 megawatt data centers, and you think, well, what would incentivize someone to build such a massively powerful, defense mechanism? And the answer is somebody's got a dam with water flowing over the dam and no one wants to buy their electricity. And so they've decided to build a Bitcoin defense center in order to monetize the running water on their dam 8,000 miles away. So there's a genius to that engineering because it's continually expanding, continually growing, continually becoming more efficient, and it anchors the Bitcoin network into the electrical network and into the technology network of the world, and it incentivizes good semiconductor engineers to be thinking all the time about how to create more efficient defense mechanisms to keep a hacker from hacking the network. And that just takes us to the last point, which is ethics. If you want an ethical monetary network, like, do you want to trust all your money in a bank run by 3 people that you know? Or do you want to trust all your money in a bank that's collectively owned by humanity where nobody in the human race can possibly hack the bank? And it's one of them is a protocol beyond the reach of any individual, any corporation, any government. Bitcoin is a system so diffuse that no one entity or person is systemically important or influential, right? Whereas Ethereum or any of these other proof-of-stake protocols, if there's a company, if there's a founder, if there's an engineering team, if you can identify them, then they can change it. And the ability to change the network undermines the integrity and the security and the immutability of the network. And the one thing you want with a monetary network is you want to know that 100 years from now, 500 years from now, 1,000 years from now, the network's going to maintain its integrity. And if it relies upon any individual action, you've already failed.
The integrity of Bitcoin as a monetary network is crucial. Saylor underscores the importance of ensuring that the network remains unchanged and secure for centuries. This long-term perspective is essential for a monetary system to be truly reliable. Bitcoin achieves this through its decentralized structure and cryptographic security, making it nearly impossible for any individual or group to alter its fundamental principles. Bitcoin's practical advantages are numerous. It allows for the seamless transfer of value across borders without the need for intermediaries. You can hold significant amounts of Bitcoin securely in your head or transfer it instantly to anyone in the world. This flexibility and security make Bitcoin an incredibly powerful financial tool, especially in a world where trust in traditional financial institutions is waning.
Is we create a piece of software using cryptography, and then the software instantiates in the protocol 21 million coins subdividable by 100 million, so 2.1 quadrillion Satoshis. Which is effectively enough. You could subdivide it more if you needed to. We create that system, and now you can send 1,000, 100, 1,000,000, 1,000,000,000, 10 billion, $100 billion worth of that from anybody to anybody without asking anybody's permission using a computer. You can hold $1 million in your head, $1 billion in your head. You can hold it in your hand. If you know you're going to get arrested, you can just zap it to your sister in Singapore. If you don't trust the bank in New York, you can put it with the bank in London, right? And if you don't trust any bank, you self-custody. That's Bitcoin. And let's say you don't, so who's going to run the software? I don't trust you to run it. You don't trust me to run it. Let's say we all liked each other. Well, do you trust your great-grandchildren? Nobody trusts anybody. So how do you create an anti-fragile, fault-tolerant, self-correcting, self-healing system that will run forever? And the answer is everybody runs the software. So everybody can download the node. It's all open source. You can read the code. You run the software. It's a protocol. If you decide you want to tinker with the code and you change the code so there's 42 million Bitcoin instead of 21 million Bitcoin, we don't recognize you. You get kicked off the network. So this is a virus. It's a monetary virus. Everybody can opt into the monetary virus or the protocol. The more people that opt in, the more powerful the network gets. So it starts as a flicker and it spreads like a flame, and then it's a fire. And then it's like, okay, I released this thing and it spread everywhere in the world. And everybody shares this common economic protocol for settling their differences in a fair and an equitable, transparent, unstoppable, immutable fashion. That is the idea of Bitcoin. If you have some money, you can't just store the money. If you want to keep your economic energy, you have to gamble it or invest it. You have to speculate with it, or you worked your entire life, you have a certain amount of retirement, and now if you store it in the bank, it'll be worth nothing. So you have to go and invest it in the stock market. But if you pick wrong, you lose it. So we basically force people to be gamblers, speculators, or hedge fund managers if the money's broken. And the money is broken. So what is the significance of Bitcoin? Well, let me say it a different way. You just take your money, take everything you earn, you buy Bitcoin, and you wait, and it goes up 20 to 40% a year forever. Or you take your money and you invest it in a bank account and you get 3% after tax, and everything goes up 10 to 15% a year in price, and you just get poorer and poorer. Or what are you going to do? Buy GameStop at the right time? Are you buy a building, run an Airbnb? I force you to go, and forcing you to be a hedge fund manager is horrifically inefficient for the society. It's just as inefficient as saying, okay, be your own dentist and doctor, right? If the medical system was broken, you have to be your own doctor. It's not good for society. What happens? People die 20 years early is what happens. So when you have to be your own banker or be your own hedge fund manager, what happens is you just get poor, or you lose faith in the future. If I told you your money was going to be worthless in 36 months, what would you do with it? You would spend it. What if I told you your money's going to be worthless next Monday? You would go out this weekend, make it decadence weekend, and you would just blow it all. You would buy anything. Things you don't need. It's like, if it's for sale, I'm just buying it. So Bitcoin actually solves the problem by saying, well, what if you just had a money that the government couldn't debase, the bank couldn't steal, that would last forever? Okay, it profoundly changes incentives, because now a corporation, instead of buying back its stock or instead of dividending out its cash flows, would just keep the money. And the money would go up in value 20, 30% a year.
The economic implications of Bitcoin are profound. In a world where fiat currencies are subject to inflation and debasement, Bitcoin offers a stable store of value. Saylor points out that holding money in traditional bank accounts yields minimal returns, often outpaced by inflation. Conversely, Bitcoin's deflationary nature means that its value is likely to appreciate over time, providing a reliable hedge against economic uncertainty. Forcing individuals to act as their own hedge fund managers due to unreliable monetary systems is inefficient and detrimental to society. Saylor highlights that a broken financial system forces people to gamble with their savings, leading to poor financial outcomes. Bitcoin, by offering a stable store of value, allows individuals to save without the constant fear of their money losing value. This shift could lead to more prudent financial behaviors and a more stable economy. Please like and subscribe my channel.